Welcome to Cambridge House Live. I'm Bridgitte Anderson and I'm joined by Danielle Park, the President and Portfolio Manager of Danielle Park Investment Council. Great to see you again, Danielle.
Yes, Bridgitte, nice to see you.
Seems like we are picking up from the conversation that we had maybe 3 or 4 years ago.
Yeah.
So let's start off on a macro level. Where do you think we are right now? What are you telling investors? What should they be keeping their eyes on?
I think it's ironic because I think the last time I spoke to you on BNN was maybe in 2006 or so, 7, and I was concerned then that we were heading into the next cyclical downturn within the secular bear. And I think we're there again. And believe me, I was bullish for a while in between. We did see value in equities coming out of the bottom in 2009, and we were invested there. But now we've pulled back again. I think that the main theme here is the incoming recession, global downturn again, which I expect is likely to continue into 12, and that is the biggest risk right now in the world.
What's driving that?
Well, it's a couple of things. First of all, in a secular bear, you start from very high valuations in stocks, and you start from record amounts of debt and leverage in the world. And it's that paying down process. The debt becomes like a drag on the world economy, and traditionally the Federal Reserves and the central banks step in by cutting rates. Now they've done that so much in the last 12 years that rates are now basically zero. So the trouble is that now we're in the realization that the stimulus has not created jobs, has not revived the overall economy, did some quick kind of juicing things to stocks and commodities, but the main theme, as I say, is this revisiting the downturn. So why that matters is because if stocks are now priced for record earnings going into 12, which they are, by the way, and you in fact get a contraction in GDP, like the IMF just came out, World Bank, saying 12 is more likely to be 2.5% in world GDP. Well, Bridgitte, that's like what we saw in 2008. So to think that stocks can continue at lofty valuations in the face of that likely scenario in 12, I think is a mistake.
Well, how bad do you think it could get?
Well, in secular bears, and I remember telling you this in 2007, and everyone thought I was mad, but it's not because I say so. It's because I've studied it since the 200 years of this stuff. In secular bears, the stock market tends to revisit its prior low each recession. You tend to get 3 or 4 recessions within the period of 15 to 20 years before everything finally gets worked out and you get into the next secular boom period. So I think that we're heading into the third downturn, third recession, third cyclical decline. So people should expect that stocks will seek to make a new bottom, whether it be the March 09 low again, which is, by the way, in the cards, or whether it be perhaps something like prior to QE2 when the TSX was sort of at 10,000. I think you might see more government stimulus at that point. You might see more desperate measures of trying to reinflate things. But whether that's successful, the economy has a weight of its own right now, and the banks can't. The central banks can pump liquidity, but they can't drive growth.
So where should investors be putting their money then?
So in our accounts, we're back to a very defensive stance. We have US dollar T-bills, we have high-grade Canadian bonds, and we have a good way to cash again. Again, cash to us is not a long-term hold, it's a strategic park for when you want to avoid the down cycles that are coming repeatedly in this, when you need liquidity. Because let's remember, what happened in the 08 and 09 downturn was a bunch of levered players started to have to sell. And when they do that, they sell like $3 or $4 of assets for every dollar of cash they have to raise. So really, there's no place to hide in risk assets. The stocks and commodities are all vulnerable. Gold as a commodity is even vulnerable in that kind of a scenario. So people think of safe havens as, I'll park in dividend-paying stocks, or I'll park in gold stocks or something. But in fact, in that kind of an environment, they all get hit. Huge correlation. So really you have to go to cash to protect, or you have to have a hedge mechanism, something to protect from the down cycle.
Yet there's concerns about the US dollar, so how do you factor that in?
Right, so we track it very carefully. Right now I'm saying that the US dollar index is the place that money has been flowing. It made a bottom at 70 in 2008, and it's now back up through 80 again. It went to 88 in the sell-off. When everything else kind of gets liquidated, you see people repatriate cash back to North America in particular. So that's been very supportive of our bonds. It's been very supportive of the US dollar. And that may continue as the European scenario continues to take shock and awe, and people are very concerned about the euro as a currency. The index, the US dollar index is 57% euros. So as that gets sold off, US dollar increases, and it's just a place to make some, again, short-term gains, capital gains, while the rest of the stuff sells off. And then, then you can pick things up at good prices again, and you'd redeploy your cash.
Do you think, you were mentioning gold a few minutes ago, do you think it's vulnerable right now?
I think that gold has to be vulnerable the way it was in '08, just as the climate I'm describing. Hedge funds got hit again in 2011. They did in 2008-9. They have to sell when redemptions come in, and they're getting a lot of redemptions. So a lot of levered players and traders and hedge funds and high frequency traders have been the main volume behind the rally in all these assets. And when they start to leave, because either they're spooked about trying to retain their profits, or whether they're having to because of liquidity and margin calls or redemption requests, they sell across the board.
Are there differences between the US and Canada, though, that investors should keep in mind?
Well, that's the decoupling hope again. And
yes.
We remember that old staple back from the last couple of down cycles. We tend to lag in Canada. And we came into the last downturn with less debt domestically, less debt on the government, less debt in the household balance sheets, and a better rule set in our banking system. So we didn't get as over-leveraged. So we did fare better in the last downturn. We still had a recession, if you remember, but it was, and our stock market still lost 50% of its value, but as an economy, we were a little more resilient. Now you fast forward to today, Bridgitte, we're not really in as good a shape as we were coming into '08. Canadian consumer is now the most debt indebted ever, worse than the US was at the peak of the credit bubble. So we don't have a lot of resilience in our households. We've got a lot of people in overvalued real estate with too much mortgage and not enough equity, and you've got still a higher unemployment rate today heading into this recession, quite a bit higher, 3 percentage points higher than we had going into the last one. So again, I don't see we have much buffer this time, and that worries me in terms of how it'll impact us this time and how long that downturn may persist.
And how big a threat is inflation? Lots of talk about it that hasn't been realized, but is that still something that could happen in the short term?
I think in the 3, 4, 5 years out, I would keep it as a likelihood or a possibility. But in the short term, I see a lot of reason for further deflation. If I'm right about asset values like housing still in Canada and China and Australia, we are still at very bubbly valuations there. And as those asset values come down, you see capital coming out, and it's sort of a self-fulfilling prophecy. Also, the stock market, as I say, I think is overvalued. I think commodities have had a hell of a good run with all the liquidity, but it's not going to jive with the demand presenting going into 12. So I think all those factors, if oil breaks below, it's back above 100, again, not good for the economy. But if that starts to come off and some of these commodities sell off in this delevering cycle, that'll bring inflation back down again. So I think that in the near term, the deflationary forces may win out. And that's why I'm not too worried about it. But I'm watching our bonds very carefully because they've been going up for 30 years and interest rates are virtually zero. 5-year mortgage rates in Canada at 2.9% or something silly. So really, when you're at zero bound, you have to be worried about how much longer that trend can continue. If we're Japan, we'll have low rates for another while because there's just not enough growth in the economy to stimulate and make the need to raise rates. But in the longer term, all bets should be on the table in terms of how this turns out. It's very unprecedented conditions in the world. We've never had that amount of systemic inflation worldwide in terms of the in terms of the monetary stimulus.
Which you talked about in your book, Juggling Dynamite, and you still think that the same dynamics are here today?
I think we fixed nothing coming out of '08. The greatest disappointment of Obama was he came in on the mandate of change, and we need to change the laws, change the rules, re-regulate the banking sector, the Volcker rule, all that stuff, and we've really accomplished next to nothing. And the U.S. is really supposed to lead capital markets in that. So the fact that they're still not doing responsible things to reinflate in terms of cash in the system, and to prosecute, frankly, some of the people that drove it into the ditch the last time. I think we'll get there, but we haven't done that yet. So I don't see a lot of grounds for thinking that we're out of the woods.
I think I'll leave it on that note. Danielle, thanks very much.
Thank you, Bridgitte.